Introduction on credit. Credit is a crucial element of contemporary economic activity because it allows people and firms to finance purchases and investments that they otherwise may not be able to make. Credit is essentially the borrowing of money with the promise that it will be repaid at a later time, frequently with interest. There are numerous ways to do this, including using credit cards, loans, and credit lines. What is credit? Credit allows you to borrow funds to purchase goods and services immediately and pay the money back later, often with interest. But the term can have other meanings. Creditworthiness. If you're wondering whether you have good or bad credit, you're talking about creditworthiness. It might sound like a buzzword, but it's important. It's a term that describes a borrower's ability to pay back credit and loans. Creditworthiness is based on things like credit history and activity. And it can affect approval and the terms of a loan, including fees and interest rates. One measure of creditworthiness is the credit score. For example, someone with a high credit score may be offered a lower interest rate because they're viewed as less risky. How credit works. Credit allows individuals and businesses to borrow money from a lender, such as a bank, credit card company, or other financial institution, to purchase goods or services or cover unexpected expenses. The lender will expect the borrower to repay the loan, usually with interest, over a set period. When you apply for credit, the lender will evaluate your creditworthiness, which is an assessment of your ability to repay the loan, by reviewing your credit history, income, and debt. Based on this evaluation, the lender will determine whether to approve the loan and the interest rate they will charge. If the loan is approved, the lender will provide the borrower with a credit line, which is the maximum amount of money they can borrow. The borrower can then use the credit line to make purchases or withdraw cash if they do not exceed the credit limit. As the borrower purchases or withdraws cash, they will accumulate debt, which they will be expected to repay, along with interest and fees, over a set period. The borrower's credit history, including their payment history and credit utilization, will be recorded and used to determine their creditworthiness for future credit applications. Closed versus open credit. Secondly, there are two types of credit, open and closed. When you have open credit, often referred to as open-end credit, such as on credit cards or lines of credit, you can continue to draw from it as you make payments. Closed credit, often called closed-end credit, is when you apply for a specific amount of money, get it, and repay it in a defined number of installments. This can apply to loans for appliances, cars, or homes. Remember that your personal and company credit may differ in various ways. The many credit options listed below are ones you might think about as your business develops. Revolving credit. Revolving credit refers to credit that is automatically renewed as you pay off your debts. It is a type of open credit. This means that there is no end date to this credit. Once you pay, the amount of credit available goes back up. While all revolving credit is open credit, not all open credit is revolving. If you do not pay your bill, a balance will carry over to the next month, and you can incur additional fees or charges. Revolving accounts can include credit cards or payment cards that individuals can use to purchase goods and services. These cards are essentially a line of credit that can be used to make purchases, balance transfers, and receive cash advances. Retail store cards. A retail store credit card is an offering you might typically see at a retailer's cash register you frequent. While some store cards are loyalty cards and do not include credit, store credit cards do. Retail credit cards typically offer rewards that incentivize continued purchases at that retailer, such as reward points or cashback. Gas station cards. Gas station cards are commonly used to pay for gasoline, diesel, and other fuels. They can come in the form of credit or debit cards. In this case, gas credit cards would be considered revolving credit. In exchange for using this card, you could receive gas discounts. HELOC, or Home Equity Line of Credit. A HELOC is a revolving loan supported by real estate. Typically this comes with flexible repayment terms so you can continue to use the credit as you pay down the balance. This equity is determined by the share of your home versus what you owe the lender on your mortgage. Click the link in my description for my 6 steps to success.